test under stress, then a, it's that's an important model risk conclusion. So in a sense, it does have a model risk dimension.
Sorry,
Yeah.
get rid of this.
What it's that's an important model risk conclusion. So in a sense, it does it. Oh, sorry, something got
No,
it.
I'm sorry. I had started the YouTube. I'm having problems moving things around on my screen. Sorry.
Okay, that's no problem. But yes, it was so stress test can also include the question, will the models cope as things go bad? And the reverse stress is asking at what point do the models fail to give us the support or the information. I'd be interested to know, has anybody around the table here conducted a model reverse stress test?
It's a very, very important point. Yes. So if we even consider just market risk scenarios, so there are two roles here. So we have a first line, and we just ask the first line. Can you think of scenarios that let's stick to like market risk. Let's say some some market factor moves 6 historical standard deviations, and we lose lots of money, right? And we can talk about what they're supposed to do, because it's hard for someone to even think what will happen in the market where correlations break, and particularly for young people who have seen market behave the same way for the last few years, to imagine something different. But then we have the second line, the model validation, who Martin's book is for. And for them, the question is different. It is how do you validate, this model and this whole process, and how do you look at the ongoing performance monitoring of this model, right? So, and yeah, so part of the stress test definitely should be and I have actually some folks do it. Yeah, so we have our, let's say, pricing model, some kind of option pricing model, and you want to see what will happen to the pricing model under all these stress scenarios that you came up, that the first line came up with. Yeah, that definitely should be part of that, because you don't want to have a situation where something moves 6 standard deviations, and the pricing model can't cope with that option pricer, right? But I think another important aspect for model validation, is it enough to just ask first line, where are your risks, what can basically totally destroy this book, cause some very negative P&L. It turned so I don't know if Martin, do you remember Alla Gill?
Yeah.
Yeah. So that's something she worked on quite a bit after she left Citi. So given a book, just figure there are actually tools to figure out. So you don't just have to ask the trader in the first line. You can, as a first a very simple approximation, say let's just run Monte Carlo on all these market factors, assuming historical correlations, assuming correlations don't break, and look what in the tail kind of produces the largest negative P&L, and that's a good start for your, then you can kind of manually pick out, the different scenarios in the tail, but that's sort of you can so that would be perhaps part of your model validation. You want to see if whatever scenarios the first line gave you actually covers all that tail.
Right. Well, one of the issues with doing it with just Monte Carlo is that you can find a lot of very severe scenarios that make absolutely no sense at all, and
yes.
And so you have to have some sort of post hoc filter to get rid of the ones where the 1 year rate goes to negative 10%, the 2 year rate goes to 30%, and the 3 year rate goes to negative 10%. And yeah,
Yeah.
you lose a lot of money there, but that couldn't
Exactly.
happen.
Yes, that is a very, very good point. So this is like a first step. It's a manual process, but it's something that should be done with validation. But yes, you have to take all these Monte Carlo scenarios in a grain of salt. Like you said, if you start if you do rates and you consider each rate as a separate market factor with volatility correlations, you will get lots of ridiculous looking scenarios that can't happen. And what a lot of people do instead is they kind of look at historical market factors, and 3 is not enough for this kind of thing. But if you take 6 or 7 and you run Monte Carlo simulations on those, you will get better simulations. Yeah, the bigger problem is that historical simulations break under stress and historical volatility. So you really want to look at scenarios where things get 100% correlation when historically they don't, or whatever, minus 100%, and things move 5, 6 more historical standard deviations at a time, right? So it's not enough, but it's something that ought to be in some way part of a validation for reverse stress test model. Yeah, just
Dimitri, so if we focus then, I was thinking about the models a minute ago. So it is reverse stress testing maybe something where you could test models with dependencies, because this might break one model and then a whole bunch of other ones might break as well. I don't know. Is that
Yes.
kind of testing that people do?
Yes. What generally there are 2 approaches. To do that. So you have your whole book, okay, and you run regressions. So not on the whole book, but you have a reasonably good sample of what you price, right? And you run the whole gamut of models under let's say rates just go up, I don't know, 400-500 basis points. How will things break? How will UPNL explain break, for example, right? And some folks actually just use a random number generator. I want the Hubert. You produce a totally random stress scenario every day, and you see what breaks under that. So it's kind of not predictable. It's just part of the daily kind of regression test. But you want to run the whole things, from back to front. So if you have typically your daily risk batch that sort of calculates PV and risk for everything officially, you want to see how that will cope with the same scenarios that you want. Yes, and you want to see what models break, and break not only in a sense they kind of throw an exception and say I can't price, but also if they produce numbers that don't make sense in a sense of their ongoing performance monitoring.
And there's another piece of this. I think we mentioned hedging, like almost like hedge effectiveness, because I think we could also ask in a question like this, like if you're worried about the short, then you can buy some stock to hedge that. If you're worried about, we didn't talk about the cash position, but I have it there so that we can introduce inflation risk, for instance. But then you could buy something to cap the inflation rate or something like that, and then have the student think about this as, maybe this is not just finding our points of vulnerability, but it's also finding our points of where we need to reinforce what we have better than what we have.
Right, because the hedging against extreme losses is not a delta hedge. It's more of a tail risk hedge
Mm-hmm.
is more of things that like deep out of the money options and insurance type things where they don't do anything except maybe cost a little bit of premium most of the time, and then they only start kicking in the really bad situation, and they don't do anything for your daily P&L being more stable. And so that it's a different way of thinking, that it's not your standard hedge for a trading book where we put on an exotic option and hedge it with the replicating portfolio of vanillas or anything like that. It's more of a we have a lot of exposure to this market. What if this market shuts down? What happens?
Is that like a break glass, or you have to get the fire extinguisher out and use the whole fire?
Yeah, and it means you have to be sure you've bought a fire extinguisher before that happens.
Right.
That it's when your house is on fire, it's too late to go buy a hose.
I mean, isn't that getting into the area of capital and reserves, at least for credit risk, it'd be reserves for, I mean, the market
Yes.
risk capital is presumably picking up that tail risk to some degree.
Mm-hmm.
Debatable perhaps, but is that enough?
Yeah, well, that's one of the things you have to test, because they since these are stress scenarios that most of the time won't happen, there's a trade-off between spending money to prevent that sort of thing happening in a stress loss where what is your risk tolerance versus your tolerance for uh, pouring money down a hole that may not exist.
Right. There's an Israeli economics professor who talks about how people in Paris buy, is it hurricane insurance, right? And the last hurricane in Paris, being far inland, was, I think 1,000 years ago, but you can still sell hurricane insurance to people who are worried. But that would be an example probably of something where you're over-insuring.
Yeah, I mean, those sort of events, without the climate risk speciality there perhaps as well, but just thinking, I mean, classic capital, the Pillar 2 Basel capital, in a sense, is I think trying to pick up that tail risk in markets as well as in credit, as well as in operational risk. It's trying to say, right, think outside the box. Stress is part of the game. Reverse stress is part of the calibration of that. And if there's stuff that's still not hedgeable or can be put into reserves or can be somehow otherwise insured in a simple way, then that has to be bundled up into the Pillar 2 number. Is in credit risk, that line of thinking is well developed. Is it less well developed in the market risk side of things?
Is that for Martin? That might be for Martin.
I mean, it's the ideas are there because they just take them from credit risk, but what's less well developed is the culture, that the market risk culture, because a trading book is very fast and you're not going to hold on to a position more than a few days at most, maybe only a few milliseconds. And so this idea about worrying about a slow moving catastrophe that might take weeks and weeks to manifest, a lot of the market risk management just isn't worried about it, not because it won't happen, but just because they think we can get out in time.
Mm-hmm.
And that's what people think about musical chairs when there's still 40 or 50 chairs left, that I'm not going to be the one person who doesn't get a chair this time. There's so many chairs left. And eventually, yeah, you are the one person who gets whacked. But the question is how lucky they feel. And in credit risk, because for debt instruments, there's no upside, that the most you're going to get is that they pay you back. And so they worry a lot more about the downside because that's all there is. And in market risk, it could go either way. And they just don't pay as much attention to how badly things could go. That you'd think all these Basel things would force them to think about it, and it does, but they only think about it just enough to satisfy the regulators.
So, yeah, so 2 points. So one of them is kind of the cost of insuring something like this, and the other one's reserves. So reserves, we talked about. I think something that might be useful, maybe just to have a student think about, is if you're given that the reserve is this amount, how much is this particular break here? Is it going to be 10% of your reserve? Quantify it in some sense. That might give you a sense of how big a reserve. As far as insurability, cost benefit, we already say in the operational risk chapter that there's a spectrum over which particularly high frequency and low loss events, a disgruntled employee gets fired and steals a stapler. You're just going to book that it's a business loss. At the other end of things, you have 9/11, and then, you can't insure against that. So I think maybe there's a way of saying, okay, so these are things on the edges that, especially that 9/11 edge, which, like you described, is a many sigma event. And then there are more moderate things. So you could have some idea about, on a model basis or on a position basis, which are the ones that are really the hot spots or things that are difficult to insure. And so that might be where you could commit your research and your time to try to make sure that you have a solid goal against something like that.
Right. It's a triage thing of things that you don't worry about, things that there's no point worrying about it because there's nothing you can do about it, and the things that you might be able to do something about and might happen that you have to worry about. And finding that balance is probably a very long and heated discussion.
One little point I wanted to add, if possible, is that when you talk to bankers, accountants about hedge effectiveness for tail hedges, they get confused because there is a lot of accounting, literature which talks about measuring the effectiveness of a kind of a day-to-day hedges. So you have a risky bond and you hedge away its interest rate risk with swap, and you can calculate daily or even more frequent mark to market and see, was this hedge effective, right? With tail hedges, maybe we should come up with a slightly different term because a lot of folks just don't think about measuring effectiveness under stress scenario for something that's supposed to work only under a stress scenario.
Mm-hmm. Yeah, it's sort of an anti tail risk. I don't know. I don't have a good term for it. There probably is one, but I can't think of it at the moment. And if there isn't one, we'll eventually invent it.
Presumably every business has a tail somewhere that where, in a sense, it's the purpose of the reverse stress test, in fact, to say, right, at what point are we entering a region where we aren't able to quantify it well enough? We don't want to hedge it because it simply would not be economic, and I'd be interested to know what criteria people use to assess that position. But there's a point at which we say, right, what would move us into this very uncomfortable zone, and let's try and fended off long before we reach that point. So that's the purpose, in a sense, of the reverse stress test, to find our appetite for the tail. Is that, I mean, in credit risk, I would know how to go about doing that because I'm quite experienced in that area. In market risk, operational risk, far less. But is it the same kind of thinking?
It should be very similar thinking, yes. That you're still doing the same thing of not so much, what if this or that obligor or counterparty goes under, but things like what if this market goes under, or if we're heavily invested in stock from some economy or other, what if that country suddenly decides it has a crisis and shuts its borders and makes its currency non-convertible. And like when Russia defaulted in the late 90s, part of what they did was they said anyone who owns our now defaulted sovereign bonds, you can't trade them. We will not recognize changes of ownership. Whoever owns them today is stuck with them. And so, what happens if something like that happens to a stock market, or if
Right.
if some of your big investments suddenly impose a wealth tax on it, and you now have a large negative dividend coming off of your assets all the time.
Yeah, I always love the story that in 1918 people were debating between, did I tell this, between buying English bonds and Russian bonds? And they bought Russian bonds because they could make 25 basis points more. So then the Reds come in and yeah, then you can't do it.
And after all, they were guaranteed by the Tsar himself.
Right.
Yeah, I think actually Taleb wrote that his grandfather had a choice of US, Argentina, Russia, and I think Germany. And out of those four, only US survived.
Now expected shortfall, I think, is in the same part of my brain as this, because Martin, I think you and I had this conversation. I think we talked about this in the book, or we should, that if we really are going to integrate out the tail, then we need to know what that is, or there have to be some assumptions anyway, or at least some sensitivity to the different assumptions of that. So if we're focusing on that tail, at least from the regulatory perspective, that they're going to impose expected shortfall, on top of VaR or whatever, then I think this suddenly becomes very important, knowing your tail.
Right. People tend to ignore that because the actual FAR tail, according to extreme value theory, the FAR tail is completely featureless and smooth. And so any event means you're not in the tail yet. And so people just ignore what events could happen out there because it doesn't fit extreme value theory. And, if your theory says that the world is flat, you ignore that you're falling off the edge.
But I mean, presumably there's obviously a great number of ways in which the tail can be built, and presumably the expected shortfall can be as large as you wish, depending on the precise distribution that you pick, just in theory. So presumably there's a standard way that pricing people approach this calculation. There's a suite of kinds of tails, various distributions that are standard off the shelf that become part of their sensitivity analysis, and it becomes then a professional standard rather than a mathematical arbitrariness that is.
Well, but the professional standard is based on this mathematical arbitrariness because they estimate the tail based on historical data. So they say, well, if if you have 4 years of data, then you know what the 99th percentile is, you know what the 99.5th percentile is, you know what the 99 3/4 percentile is, and let's just extrapolate from that, assuming it's smooth. And you say, well, it's a fresh A-shaped tail according to extreme value theory, and we can justify where our estimator starts because we can show that based on this historical data, it looks like it should have this shape, and then your reverse stress test is going to be, well, what if it really isn't that shape? What if way out here where you said it's smooth and featureless, sitting on that nice curve is a dragon?
Yeah, you kind of, if you rely on your first line to come up with these stress scenarios, they kind of have to have enough clue to think of scenarios that are not like history, right? Yeah, if as long as you are basing your simulation and the tail on history, yeah, you are going to miss, things that can happen and might happen if you look even over the 100 years worth of history for stocks. It's kind of I think my favorite example in the last couple of years was, March 2020 when the lockdown started, and everything moved, everything I would say moved in ways they never did and hopefully never will. But that's kind of a really nice stress scenario, kind of a flight to quality. Mhm.
Well, I mean, it's possible that things like that happen before. There have been plenty of plagues and such, but if you're not studying history, you're not going to pick it up. And traders are not known to be careful students of history. That like how many of them know that the U.S. went bankrupt in 1931?
I don't even know that. I do know that individual investors freak out. My brother-in-law called me up in March 2020 and said, I want to sell off all my positions. And I said, don't. Just tighten your seatbelt. What are you, crazy? You want to lock in all those losses? But yeah, a trader might think that way. It's just going to be going down forever.
I wonder if crises are a bit like, reasons for crises are like different. Well, there's a problem of counting species. So you're out in the field, you're out in the jungle, and you're collecting things. So a leaf, an ant, a flower, a small animal, and eventually, you find that, of course, you're collecting the same creatures a second time, third time, but you're still aware that there are new species out there. And the question is, how, with that very, very loose information, do you predict the probability of picking up a new species? So thinking of reasons for crises or reasons for stress, there's a new reason cropping up every now and again, but old reasons happen as well. So the problem that problem was solved, or at least one solution was given by Good and Turing in the 1940s. You can actually give the best information-free estimate of the probability of a new species being found. And the solution is quite elegant. If you look up Good Turing distribution or Good Turing estimate, you'll find the solution if you don't know it already. And I'm wondering if actually there's a similar analysis can be made for reasons for crises or reasons for stress. I just throw out Ajna's idea. It just suddenly crossed my mind there. Any thoughts?
You probably could, except that the probability space is probably too big for you to be able to apply it, because you just, relative to the possible number of crises, you just don't have that much data on already occurring crises. And you have to use your imagination more.
Definitely, and if you like, the good Turing solution is an imagination free. In other words, given no holds at all in this, what's the best we can do? And they come up with a number, if you like, a Bayesian information free, or as free of information solution as possible. Naturally, if you do know more about the probability space or the likely crises that are on the horizon, then that helps refine the analysis. But I'd just be interested if it throws any. In a sense, you can get a number with minimal information, which is one of the fascinating outcomes of this analysis.
Certainly something we can think about. It's a good idea.
It just crossed my mind. It probably doesn't help us, if the probability of finding a new crisis or a new kind of crisis is 1 in 3, does that really help us? It just makes us more nervous, I suppose.
Right, but let's say if it were mushrooms, okay, so you could find the probability of finding a new kind of mushroom, but as far as impact, are you going to eat that new mushroom? What is this a toxic, really toxic mushroom, or is this just, so it's not necessarily, it's good to know probabilities. It's also good to know impact. I guess that's what the models are for.
Yes. No, it's
So what I'm thinking is it's about 8:45 in New York. One thing that like the reverse stress testing is in a chapter right now about CCAR and some of the more regulatory approaches. And I guess I'm interested in tapping your knowledge about Alan, Dimitri, David, about how CCAR is around the world, outside. I saw European Banking Authority does a yearly and an every other year, and I know what the Fed does. But like how many, and there's nothing like a Basel CCAR, right? Or it's just up to individual countries. Are there like very strict CCARs, say in the UK, that are separate from what the European Banking Authority would do, for instance? Or what about some of the other majors?
Well, I think one, actually, it's a true story. And in Russia, they have a whole bunch of small banks currently, and they have a regulator, the central bank, with a very competent lady in charge. And they put out stress scenarios kind of similar to CCAR. And given how Russian economy depends a lot on selling fossil fuels,
Right.
Many of the stress scenarios involve fossil fuels. So at some point, they had 3 stress scenarios. The price of oil goes up a little, the price of oil goes up a medium amount, and the price of oil goes up a lot. And somebody from a small bank said, wait, how come we don't have a scenario where price of oil goes down? And the central bank said, that would be unpatriotic. True story. Actually, yes. So yes, quite a few places. Quite a few little countries have their own little scenarios.
Yeah, that's a good insight. Yeah.
The problem with CCAR is the names, but we can. I think Martin and I can think of one particular GSIB that probably would not be passing CCAR at all if not for political pressure. But it wouldn't be acceptable to put these guys out of business. But yeah, so I work on CCAR quite a bit, and it's if a politician says that this institution has to pass CCAR, they will. Right. So yeah, but I think taking a step back, a lot of this, these things that people do, like reverse stress tests, or even the whole model risk management, framework. A lot of institutions do not because the regulators force them to, but because they see it as a kind of a good, best industry practice, right? So there are, financial institutions out there that are not banks, so that don't have to follow SR 11.7, for example. But they say, oh, we see all these banks doing all this, good stuff for SR 11.7. Well, let's have a model inventory. Let's have a formal second line of defense for model risk. And, they wouldn't have done it, maybe 30 years ago because nobody kind of knew what to do. But now that we have lots of people from banks who implemented SR 11.7, yes, they do it. It's a bit of like, so it is like that with stress testing as well. Yeah, like for example, we have all these European banks that have some operations in the US. And initially, when SAR 11.7 came out, I would say more than half of them took the approach that we are going to have a model risk management framework for the US. And as long as the model is not being used in the US, we don't have to do anything with it that we haven't done before, right? And then they saw the benefit of it. Look, you have fewer models that blow up, right? So it's kind of the same way with stress testing. Yeah, we have a CCAR. I would say at this point, many smaller institutions that are not subject to CCAR or that are subject to CCAR, they have a lot more stress scenarios, stress testing, reverse stress test, the whole library of 50 or 60 interesting historical stress scenarios like March 2020 that we keep talking about, or various events in 1998. And they look at it, look at what happened with their book under those scenarios, even though it's not a regulatory requirement for them. It's just a good business practice.
An example from my personal experience, not about stress testing, but about model risk itself, in insurers, that someone who I worked with at a previous job is now head of model risk for some particular asset class at New York Life Insurance. And they're not required to do any of that. There's no such regulation. They do all these things anyway because New York Life is very cautious and worries about such things and wants to do it because it's good business practice. However, AIG and Prudential, and I forget what the third one was, were told that they were going to be designated globally important systematic financial institutions, and then would be required to do CCAR. And I worked at AIG doing CCAR for a few months, and their lawyers were fighting tooth and nail to get out of being CCAR regulated and stop being SIFIs. Within like 2 months of when the government said, all right, you're not a SIFI anymore, AIG laid off its entire model validation staff, every single one of them. They said, we don't have to do it. We're not going to do it. It's not worth it. We're an insurance company. We have actuaries. Now, insurance companies, if you don't know, they take in premiums every month, and then for life insurance, 30, 40 years later, they pay out on a claim. And so that means they have 30 or 40 years to play with that money. And they don't care about liquidity because, they have 30 or 40 years. They don't care about short-term trends, which happen, because they have 30 or 40 years. They care about diversity because who knows what's going to happen in 30, 40 years. So any weird asset class, they're in it. that's why AIG got caught with so much of the weird CDO tranches, because it was something that was very uncorrelated to the other things they had. And so that they're actually wild ass gamblers. You think of them as staid, boring places, but their asset investment arms dabble in everything as much as they can, and their mandate is to diversify.
Yeah, I've talked to the New York Life people, just kind of the general model risk people. Another aspect they have, which banks don't have, is finding new customers, and they have models to do that. But there've been some legal cases, but there's some legal risk now with their models, especially AI models, that they tend to pick white males, for instance. So Colorado and some of the other states are really looking carefully at those. I don't know what you would call them, screening models or business development models.
I think they call them prospecting models.
Prospecting models, yeah. So that's something that they don't quite understand, I think, how those models work. But right, managing the asset liability, especially the asset side, that's a big duration risk if you're going out 30 years, yeah.
Yeah, if I may add one small note here. Yeah, it's not quite correct that insurance companies don't have to do model risk. There is actually a public policy practice note from the American Academy of Actuaries on model risk management. It came out in May 2019. So it's more than nothing, but it's very minimal. It's like nothing comparable to SR 11.7. Right, so yeah, they can get away with not having any model validation. Yeah, they do have to have a little bit of model risk management framework according to this.
Part of that is that it's state regulation and not federal. Just like there were state banks to begin with, but then we have the idea of national banks in the 20th century. Insurance is still very much at the state level. So in New York State, you're much more heavily regulated than you would be in another state. The other thing I wanted to pick up on, we are running out. I think it's important that you said that Russia was a resource-based economy, because Canada, our neighbor to the north, obviously, is also very resource-rich. Or even the extreme in a U.S. state, Wyoming is a state that just is boom and bust on the prices of oil and minerals and things like that. So I would think that the mindset of this kind of reverse stress testing and model risk in general is very different between a post-industrial economy and something that's, at least in economic terms, it's more like an agricultural economy. You're farming oil and things. So that would maybe drive the way, both internally and the way that the regulators would ask the models to be validated and measured.
If your economy entirely depends on oil, and you have some model risk on interest rates, the basic answer is who cares? That's not our problem.
Well, if it's in dollars, just like the Saudis getting off the petrodollar, I think that was in the last week or so, and trying to use another currency like the Chinese currency. Then there's definitely rate risk and currency risk all over the place. But if it's just like a domestic asset, which is not the world market, sure. Go ahead, Al.
Sorry to draw attention to your original question, Jonathan, about UK and European stress testing. Just very quickly, at times pressing, obviously. If you look up the ACS alternate cyclic scenario, you'll get the basis for recent stress tests of banks in the UK. So that's Bank of England, Prudential Risk Authority, PRA initiative. The large banks in the UK, so the top 7 or 8, were required to provide a detailed response to the ACS exercises, I think in place 2019, 2020. Okay. These were a combination of all sorts of events, economic events, Credit was part of it. These banks, where they had a market exposure, the market risk people would have to contribute. Operational risk. It was a combined exercise that it had some had some solid thinking behind it, and I think they had to pause during COVID because of other stresses happening. Yeah, but I think they'll pick it up again, or they have been picking it up again.
Okay, that's fine. I'm sorry. Yeah. So we'll wrap soon. Last comments, I guess. I'm just going to pick on David because he's been muted here and hasn't said anything, but I noticed that he has a SaaS background. One of the things I'm thinking about the book and model risk in general is that there are people who will buy SaaS to do their model risk or interrogate their models. And while we talk about, third party for things like anti-money laundering and for some of the pricing things, we haven't talked about people who buy a system to do something like that. I think SaaS is the most major one. It would sort of be interesting to see what types of things you can automate. The other way to automate it we have talked about is with AI, but there may be some parts of SaaS that use AI to interrogate and manage the models. Maybe I can get him to talk next time. Other final thoughts once again for everybody. Tomorrow is it's a holiday in the US, banking holiday.
Enjoy the holiday. Any good plans?
It's sweltering heat. It's like, I don't think it's 40 Celsius, but it's going to be high 30s or feel like high 30s.
My plans are to go outside, make sure the plants are watered and not wilting, and other than that, stay in. And the priority is to not get heat stroke.
Good luck.
Yeah, I'm in California. None of that stuff is happening here.
Right, it's just burning up. The state's burning up, but as usual in the summer. So they say that in the times of the Indians, since there were no firefighters, probably the entire state, beautiful California in the summers, probably all summer was just ash and smoke and everything. So
no, they had controlled burns all the time because the Native Americans Native Americans found that if you want to have the deer really happy, so you have lots of them to hunt, you have a forest with the trees fairly widely scattered and not a whole lot of brush in between, so that there's nothing for the deer to be scared of. So every spring they would set fires deliberately and keep the brush down, so you wouldn't have these major conflagrations, which are because of decades of the Forest Service putting out every little blaze as soon as it happened.
Yeah.
And now you have to do that because there's so much brush buildup. You can't have a controlled burn.
Well, and people put their homes within 50 meters of where a fire is going to be. So.
Well, they also put their homes within right on the mountainside where if there's a spring rain, which there is every other year, the house slides down the mountain.
Right.
But it's such a beautiful view that they pay the cranes to crank the house back up, and they do that every other year. And you have these $5 million houses or $10 million mansions with beautiful views down the valley from their in the middle of the mountain view, and they have their plumbing and such hooked up so that when the house inevitably slides down the mountain, it's easier to hook back up when they get it winched back up.
Well, I think now we are over. Now that's crazy, but I think that's the kind of risk that we are not going to have to worry about here.
Well, I don't know. I mean, it's an example of resilience. Is this how banks should work things out?
Right. Should they write a mortgage for a house like that?
Well, actually, it's an interesting example. If you can spend another 30 seconds, okay, there are institutions out there who are not banks. They're what they call mortgage bankers. Right. So they write mortgages, and then they generally repackage those mortgages and sell them off. So they actually have quite a bit of interest rate risk if they don't hedge it, because they write a bunch of mortgages, and they typically have what's called a pull-through model. They so they'll lock in some kind of a rate for a certain period of time, and they try to estimate the probability that the people will actually take advantage of this locked-in rate. And these models can get quite complicated, and there are vendor models out there, but most folks have their own in-house model. So now these institutions, unless they're part of a much larger bank, are not subject to SAR 11.7, but I would say most of them have seen the light and they try to actually validate these models. They definitely measure the ongoing performance. They do ongoing performance monitoring of those things. Yeah, so it's a nice example of folks, having doing the right thing mostly.
I
You don't have to. Yeah.
I did a model validation like that in the mid 1990s before there was anything like SR 11.7 or even even the 2001 version. But the mortgage bank, which was owned by Chase, which is now JP Morgan Chase after a few mergers, had lots of vendor models and a model for the rate locks, which was mostly just, they said, let's guess it's 50-50. And the data was not too far off, but there were certain characteristics that helped you make a better guess than 50-50, which they ignored because that particular mortgage bank had a policy of not actually having any quants, so they couldn't build any better models, and they had lots of vendor models for the quantitative stuff, which they didn't quite understand because they had a policy of not having any quants. And that's changed now, that the quant isn't a dirty word anymore.
Yeah, I'm sure it's gotten better. No, it was, when I started working in the industry in the 90s, it was quite horrible, and things have improved. Yeah, I'm sure they have better vendor models now, and if they have internal models, they actually look at the data and they look at what can happen, because in a situation like this, folks are not going to make use of their locked-in rates if rates, kind of so it doesn't make economic sense for them to use this rate. So it's a stress scenario which you're not going to see right away on historical couple of years of historical data. So I'm sure it's much better than it was in the 90s. Mm-hmm.
Okay, so thanks everyone. I'm just going to cut it because I need to go.
All right, thanks.
You may have a transcript coming to you, or trying out a new transcript feature. If it's 50 or 100 pages long, just ignore it or use it as wallpaper.
Bye.
It's not useful. Take care. See you next week.